let me start first of all with what I think is a general picture of the world economy, because as the crisis has gone on, I've sort of thought several times, are we going to see another Lehman Brothers type moment? Are we going to see a slow decline into stagnation? If you want a picture of what the world economy looks like at the moment, imagine a hamster drowning in a barrel of honey. Periodic thrashing around, getting swifter and swifter, lots of squeaking, and a slow sinking down into a sticky mess. That's the picture I want to present of the world economy. I'm not sure that a hamster drowning in a barrel of treacle looks like that, by the way. I've not tried it, but I imagine that's roughly what it looks like. One of the signs of this is if you look at the various deals struck in recent weeks, if you go back to 2008, 2009, periodically there have been bailouts, rescue schemes, stimulus packages and so on. Early on in the crisis, that would buy the ruling class a matter of months, several months, or at least several weeks. You look at the last two rescue packages, you look at the bailout of the Spanish banking system a few weeks ago, it bought the ruling class all of 2 days. And then the crisis erupted again. Look at the deal struck by the Eurozone leaders last weekend. Already that deal has unravelled. Already bond yields for Spanish bonds have shot up above the 7% mark. The kind of rescue measures they come up with buy them less and less time. And there's a real sense now, I think, that the crisis, as we've said for a very long time, is both extraordinarily deep, is comparable with the crises seen in the late 19th century, the first Great Depression, comparable in scale with the crisis of the 1930s. And secondly, because it's a deep crisis, and because the underlying problems that the system faces haven't been resolved, it's likely to be a very long crisis. No crisis is necessarily the final crisis of capitalism, but however, getting out of this crisis is going to be incredibly difficult for the ruling class. That's a point I'll return to. To understand the crisis, we can look at all the surface features of the system, the banks, the barbarism of what the bankers are doing to us, the financial system, and so on and so forth. However, I want to do something different. I want to start with the underlying tendencies in the capitalist system. I want to start from that and use that to explain what's going on. And the most basic tendency in the capitalist system, as I think most workers recognise, is profit making. It's a very basic point, but the capitalist system thrives on, is built around, and is based upon squeezing working class people, living labour, as Marx put it, in order to extract profits from them. It's the most basic and essential driver of the capitalist system. The second point, though, is that the profits that are squeezed out of workers are reinvested, and the reinvestment takes the form of a massive build-up of what Marx called dead labour, a mass of machinery, equipment, new technologies, and raw materials, which drives out in relative terms the very thing that creates new value. There's pressure on profitability because in order to grab the same amount of profit, capitalists have to invest an ever greater amount in machinery, technology, and so on and so forth. There are many meetings at Marxism which will look in more detail at those things and try to explain them, but I want to capture what I think the basic tendency is. Because of that process of the build-up of an ever greater mass of dead labour, there's pressure dragging down the rate of profit, the rate at which the system can expand. I want to start with, there's going to be many graphs in this meeting. Sorry if people don't like graphs, I like graphs. This is one measure of the long-term decline in the rate of profit for the US economy by Andrew, who's sat over there and is speaking tomorrow, and if someone wants to attack it, I'm sure he'll come up and defend it. There are many different measures of the rate of profit for the US economy. This is one of my preferred measures, which is to look at the entire corporate sector for the US and to measure the profit expected from that corporate sector against the historic cost of the investments that are made. What kind of return do people get on the investment that they make in the system at a certain point in time? And if you look at that graph, there's a very, very clear pattern, and it's reflected in many other measures. This is a particularly dramatic version, but there are many other people who've measured it and come to very similar conclusions. There are two things that I think we should say about that graph. The first thing is that the period from the end of the Second World War through to 1982 is a period of a long decline of profitability in the US. The second thing is that profit rates haven't recovered in a sustained way since 1982, that the US economy, but it's also true of other major economies, have been trapped in a period of low profitability for a very long period of time. One other feature, of course, is that profit rates don't simply go down in a straight line. They go up and down. There are cyclical patterns, there are business cycles, and so on and so forth. That's, of course, very confusing for some people who go from 1982 to, say, 1997. And if you draw a line from 1982 to 1997, you can perceive a rise in profitability. And you say, oh, capitalism's climbing out of the hole. If you look at the whole period, though, things don't look so great. Marx also made clear that as well as this long-term pattern, which extends over many different cycles for the rate of profit to fall, profitability can rise as well. Marx didn't have an account that said that the rate of profit falls and falls and falls when capitalism collapses. It's a caricature of the Marxist method. There are many different ways in which profitability can be restored. Obvious one, squeezing workers harder. Opening up new lines of production which involve less machinery and technology and so on. By far the most important way that Marx understood profit rates could be raised was through what he called the devaluation of dead labour, driving down the value of machinery, of equipment, of technology and so on. And that's something that goes on all the time in capitalism. Capitalists compete by accumulating and driving down prices, and of course that means they drive down the price of technology and the equipment the capitalists use and so on and so forth. However, I think it would be wrong to see the movements in profitability as being completely indeterminate. They go up a bit and down a bit and we can't really decide which way they go. Firstly, because empirically that's not really the pattern we see. But secondly, because this regular devaluation of dead labour that Marx talked about doesn't necessarily help all capitalists. For example, if I'm a capitalist involved in the print industry and I pay £10 million to buy a huge printing press, the fact that someone else invents a printing press that does exactly the same thing for £5 million doesn't help me. I still have to pay back the £10 million where my rivals are undercutting me by investing in a £5 million printing press. This process of the devaluation of dead labour can help some capitalists, but it hurts others. It can diminish profits as well as raising them. How is it then that capitalism can restore profitability in a sustained way? These are two quotes which I'm not going to read them both out, but they're two quite important quotes in which Marx is talking about first the way in which this process of accumulation undermines itself, but the second one, which I think is the important one for our purposes, is the way in which Marx talks about crisis. This process of the devaluation of dead labour is not a smooth, continuous process. It's a process that erupts through crisis. Crisis is the moment where the capitalist system can devalue and depreciate capital across the whole system. It's through the eruption of crisis that firms collapse and are bought up by their rivals, firms dump their output on the markets at a fraction of their real value, simultaneously workers are squeezed by unemployment, and these kind of processes provide the boost that the capitalist system requires. And that's why Marx talks about crisis as a momentary suspension of labour, the annihilation of a great part of the capital, which violently lead capitalism back to the point where it can go on fully employing its productive powers without committing suicide. In other words, you can't talk about final crisis for capitalism. Maybe we talk about ecological destruction, the possibility of capitalism destroying the planet, that's a possibility. But within the workings of capitalism, there are mechanisms that can restore the rate of profit, but at huge cost, the cost of having to destroy large chunks of the system itself. That's the first tendency in the system I want to talk about. The second tendency that we have to talk about is the way in which capitalism has changed historically. Because, to go back to this graph, the big fall in profitability clearly isn't happening in the 1980s and 1990s. The big fall in profitability is happening during the post-war boom. And the question this poses is why didn't the crises of the 1970s and early 1980s, why weren't they able to drive up the rate of profit once again, as had happened in the long period of crisis from 1929 through to the end of the Second World War? Why was it? And my explanation for that is that the process of destruction didn't take hold sufficiently to clear out the system of unprofitable capital and pave the way for the restoration of profitability to the kind of levels experienced in the late 40s and 1950s. And the central reason for that is a process that Marx called the centralisation and concentration of capital. The fact that over time, the units that make up the capitalist system, the capitalist firms, tend to get bigger and bigger, both through reinvesting their profits, but also in every crisis, capitalists buy up their rivals, they merge, they take over one another, and the units of capital get bigger and bigger over time. By the end of the 20th century, you're talking about a system of huge units of capital bound together by 1,000 threads and connected often quite intimately with the financial system and with the state. And the state is a big player in the modern capitalist economy. I've been trying to find a way of measuring the concentration and centralisation of capital for a long time, and if anyone can come up with a good way of measuring this, I'd love to know it. This is just a very kind of hand-waving way, but it kind of indicates the kind of degree of concentration of capital, how few capitalist firms dominate key areas of the world system today, like automobiles and various other bits of the world economy. Huge levels of concentration, and it creates a dilemma for the ruling class. Do you let crisis rip through the system and destroy some of these behemoths of the capitalist system, or do you find ways of bailing them out? Does the state step in and try and rescue failing firms and try to put a lid, put a floor underneath the crisis? And my argument is that in the late 20th century, increasingly the doctrine of too big to fail, the doctrine of intervening to bail out companies came to the fore. The big clear out of the 70s and 80s didn't happen, and that's the reason why. That's a fundamental reason why the capitalist system has remained in a period of what Andrew Kleinman and I would call relative stagnation of capitalist production. Not absolute stagnation. It's not a permanent crisis. There are bits of a system that have expanded very rapidly. There have been periodic mini booms, bubbles created in the system, and all sorts of things. It's not permanent crisis in that sense. Nonetheless, powerful tendencies towards stagnation across large swathes of the capitalist system. The third trend within the capitalist system, which has been widely remarked upon, is what's often called the tendency towards financialisation. I don't really like the term financialisation, but it's a term that Marxists tend to use. We have to start by saying, though, that the financial system isn't some parasitic outgrowth on capitalism. It's not some thing over here that kind of grows and grows and grows and it drains, it kind of leeches off capitalism. It's more complicated than that. If you read the third volume of Capital, Marx makes it clear that finance is intimately bound up with the workings of a capitalist system. For a very simple reason that capitalists in one point in the system might have profits that they can't find a means to invest them. Other capitalists might want to make investments but not have access to profits. What does the financial system do? It finds a way of drawing together value that can't be used, that's lying idle, lending it to someone for interest, and allowing them to use it for this process of profit-making, accumulation, and so on. Marx says in the first quote there, banking and credit become a potent means of driving capitalist production beyond its own limits. The first part of the quote. And we shouldn't forget that side of things. But it also becomes a vehicle for swindle and crisis. It pushes capitalism forwards beyond the level it would reach, but it does so by creating chains of credit and debt which extend across the system, by generating huge financial bubbles at certain points, which can then collapse and drag down even the healthy bits of the system. Finance is bound up with the workings of the wider capitalist system. The third quote is very, very important in this context. Marx argues if the rate of profit falls, we have swindling and general promotion of swindling through desperate attempts in the way of new methods of production, new capital investments, and new adventures to secure some kind of extra profit, which will be independent of the general average and superior to it. Think about the last 30 years. We've had an endless process of swindling and the general promotion of swindling through desperate attempts, Bob Diamond being the epitome of this process, perhaps. But this pattern has gone on really over the last 20 or 30 years. Desperate attempts to move into bits of the financial system in order to try and find a way of generating profits over and above what can be obtained in the productive sphere. One thing that I think everyone accepts, we've seen a massive growth of these sectors. These are just some graphs pretty much taken at random, showing this. This is total debt, consumer debt, government debt, and corporate debt across three major economies from 1980, 1990, 2000, and 2009. This is the extent to which corporate profits in finance in America have become a very, very important part of the US capitalist system. This is the other bit that which is hidden below the surface of traditional banking. It's the so-called shadow banking system, things like hedge funds and so on. And it just shows the extent to which the liabilities, the money pumped into this bit of the system has grown. And the roots of the growth go back a very, very long way, but this growth takes off and becomes almost exponential in the takeoff until 2008, where it turns down, and interestingly it's begun to level out and pick up again. Okay. But it's very important to say when we're talking about financialisation, we don't separate it from the wider economy. Capitalism as a system has become increasingly dependent on credit expansion from through the 80s and 90s and so on. That's not some autonomous process that goes on separate from the capitalist system. That's a consequence of the inability of the system to generate value as effectively as it hitherto had. The importance of credit is in direct proportion to the failure and the undermining of capitalist production of value. That background, understanding these different trends, I think it helps us to explain a little bit the dynamics of the crisis. How am I doing for time? 15 minutes, fantastic. When the crisis first broke, it broke in the US economy in the subprime mortgage market. It broke, first of all, among poor Americans, often black and Latino Americans, who had been persuaded to take out mortgages that they couldn't really afford on their homes, which created a huge bubble, the subprime mortgage bubble in the US economy. The point at which the housing market turned down and people started to panic about these investments was the point at which the crisis first broke in 2007. The amazing thing is, if you go back and read some of the financial press in 2007, what did people say? People said, first of all, that the problems are concentrated on the subprime mortgage market. Don't worry about it. The wider system is fine. The wider system will be okay. They can contain these problems. One of the most amazing articles which I found in an old FT specifically said, don't worry, because securitization is doing what it's supposed to do. It's spreading the risk. It's spreading the risk. Now, that would be okay if the system more generally was booming and was driving forwards at a rate of knots. The problem with spreading the risk when the underlying system is so weak and fragile is spreading the risk can mean a small explosion in one part of the system, breaking these chains of credit and debt and dragging the whole system down with it. So it was, first of all, with the bursting of the subprime bubble in 2007, and secondly, far more dramatically, with the collapse of Lehman Brothers in 2008. The sudden panic over the so-called dead bodies floating to the surface, the toxic waste in the financial system, but underlying it all, the weakness of the capitalist system. For all those people who believe the hype about the so-called neoliberal boom and the restoration of growth rates, these are some measures of the per capita global rate of GDP growth. For all the talk about neoliberalism, its capacity to restore growth rates per capita were very, very limited. in the 1980s and 1990s. Okay. I want to say a little bit about some of the fault lines in the current crisis, because it's not simply in the subprime mortgage market that you see this overextension of credit. Out of the last 20 or 30 years, the problem of credit overexpansion has become a general problem in the system, and the problems are particularly sharply concentrated in the Eurozone. I mean, it's very obvious that there's a problem. I don't know if people remember back in 2008 when the subprime thing blew up and Lehman Brothers collapsed. What did the Spanish banks do? Spanish banks went on a spending spree. Banks like Santander went and bought up a whole range of high street banks in Britain. The perception then was that Spanish banks were fine because they hadn't invested in subprime. What you find, though, is that there's a particular bubble in construction and housing in Spain that those banks were incredibly heavily exposed to. The problem of credit was a general problem, and it was particularly concentrated in the weaker economies. The Eurozone as well, I would argue, involved credit expansion in its very construction. It's a general problem in capitalism, but the way that the Eurozone was put together made it even worse. It drew together different economies with very different levels of development, very different structures. But because they shared a common currency, the way in which ruling classes in different countries tried to increase their competitiveness was not by devaluing their currency or doing other things, manipulating things in other ways, but was fundamentally through holding down wages and attacking workers. And the most effective player in this game, in this race to the bottom, was Germany. Not that German workers are paid less than Greek workers, but the ability of the German ruling class throughout the period of the Eurozone to hold down German wages was far, far more effective than any other Eurozone country. This is one estimate. The line at the bottom is Germany, the other lines are all the rest. These are the unit labour costs in different economies. You see how effective the project of the German ruling class was in holding down the wages of German workers in order to boost German competitiveness. Weaker economies were less successful in that race to the bottom. However, those economies could consume German exports and could consume other exports from the stronger economies of Europe, and they could do so on the back of a wave of credit expansion into these economies. Spain and Greece were not as strong an economy as Germany, were not as competitive, but they could borrow at pretty much the same rates whilst the Eurozone was intact. There was a tacit assumption that all of the debts were underwritten effectively by Germany and the stronger economies in the Eurozone. This is why you get this process of credit expansion at the edge of Europe underlying the period of the Euro. When the crisis hits, what do you get? You get a situation in which some of these debts go bad. Sometimes states are forced to shoulder some of the burden, to socialise the debt. And on top of that, you get a situation in which tax revenues begin to fall, putting increasing pressure on so-called sovereign debt, putting pressure on governments which are having to borrow to cover their costs, and are having to borrow at increasingly extortionate rates of interest because people are betting on them to fail. One by one, they were bailed out. In the case of the lucky Greeks, they've been bailed out twice now. And every time they get bailed out, they impose austerity, and the austerity seems to have the impact of driving the economies deeper and deeper into recession. Because there's no restoration of profitability or of growth, the burden of debt actually gets bigger and bigger. The most simple reason why Greece should default now is that Greece has no prospect, really, of ever paying back its sovereign debt. It's simply not going to happen. And it's absolutely immoral that the Greek government now spends far more servicing its debt than it pays on the entire social provision of healthcare, education, social services in Greece, a country now being hit by 1930s style depression phenomena like soup kitchens, mass homelessness, and so on. The other feature of this debt crisis in Europe, though, is incredibly sharp debates taking place within the ruling class. And the debates reflect the wider dilemmas faced by the European rulers. And essentially, these translate the problem of too big to fail from individual companies to whole governments. That's essentially what's happening now. Should the German ruling class allow the Greek government to default, and if they default, they'll probably have to leave the Eurozone? Should they allow this to happen? Now, there's an upside to doing this. If you allow these bad debts to collapse, which will never be, it's fine. If you allow these bad debts to collapse, if you allow this clear out of capital to happen, potentially it could pave the way for growth somewhere down the road. But the price for doing so can be absolutely immense. First of all, because German banks are heavily exposed to Greek debt. The German central bank is exposed to the tune of about 700 billion euros now, a colossal exposure. German banks are exposed even more, about 800 billion euros, according to the latest figures that I've seen. Huge level of exposure, which will have an impact on the German banking system. Secondly, if Greece leaves the euro, it raises questions about the future of the currency bloc as a whole. Again, the Financial Times estimated, or quote an estimate of 650 billion euros of losses in trade for a result of the breakup of the Eurozone. Thirdly, almost certainly markets would start betting on the next domino to fall. Almost certainly they would go from betting on Greece to default to betting on Spain, Italy, and the rest of this whole chain of states to fall. What's the alternative? The alternative is to bail out the Greek system. Okay, there are advantages to that, but again, there are huge downsides. The mass of Greek debt can become a burden on much more efficient capitalisms in places like Germany. And secondly, paradoxically, the failure to clear out these bad debts, the failure to let the crisis rip, can end up in a prolonged period of stagnation and a failure of recovery to arrive. This is the hamster sort of dropping down into the barrel of honey and starting to suffocate the long process of stagnation. Okay. Finally then, what do we say about the solutions to the crisis? What I've tried to draw out is that the chaos in the Eurozone, a particularly profound chaos when it comes to the arguments of a top of society, is not rooted particularly in the stupidity of our rulers, although they've shown colossal amounts of stupidity as well. It's rooted fundamentally in the underlying contradictions that they face in trying to preside over a capitalist system which operates according to the laws of motion, of profit making, of centralisation and concentration, and a need to self-annihilate large chunks of itself in order to recover. They face that contradictory logic. I mean, it means there's a logic both to austerity and a logic both to stimulus, but the logics point in different directions. This is why you get these endless arguments taking place in the ruling class, the cracks at the top of society, and the general ideological turmoil. It's very important to understand that. Secondly, the crisis isn't a final crisis any more than the crisis of the 1930s, but my argument is that what it will take to restore profitability is a far, far greater process of both destruction of bad debts, but also destructions of parts of the capitalist system. There can be growth at some point in the future, but the process that we'll have to go through will be extremely traumatic. Let me, these are graphs from Michael Roberts' excellent blog, which the URL's at the bottom. I highly recommend that people check it out. One of the points that Michael Roberts has argued most effectively throughout this crisis is the need to look at profitability. You have to look at profitability. It's not enough to look at the financial system and loans and so on, and quantitative easing. You have to look at underlying profitability. And the reason why this graph was particularly striking is what you see is a momentary surge in particularly in US profit rates as they manage to deleverage, as they attack workers and all the rest of it. But what you're seeing now is that process beginning to run out of steam. And if you look at the other economies, they haven't even reached that kind of level of boosting profitability. My argument is until they solve this problem, the crisis is likely to continue. Final point. I mean, there's lots more that could be said, but I think I'll wait for the discussion, and people may want to talk about particular bits of the system and what's happening there. But I think it has very, very important implications for us. if what we're talking about is a long period, potentially years or even decades long periods of crisis, then the crisis will not be one single uninterrupted process. It will be a process that passes through many different phases, and within that long crisis there will be spaces in which resistance can begin to develop. There'll be debates at the top, and as cracks forms at the top, those at the bottom of society can begin to put forward our arguments and solutions and begin to gain a hearing from groups of workers who are fighting back. We need to understand that we're in for the long haul, and we need to both make clear arguments about capitalism, but also patiently try and accumulate the forces at the bottom of society that can begin to fight for working class solutions. Secondly, the instability, the fact this long crisis is punctuated by upheavals and flashpoints, means that there will also be glimpses in which moments in which there will be potentially revolutionary situations. You've already seen this in the Arab world, where a crisis partly formed by this context of global crisis of capitalism created a revolutionary situation. We're now seeing some of those tendencies at a very early stage developing in Greece. And out of these potentially revolutionary situations that are beginning to emerge in a very small way, one enormous sign of hope is you get tiny glimpses of workers beginning to form their own solutions from the bottom upwards. I've shown you lots of very depressing images. Let me end with a much more optimistic picture about what the future could look like. This is the equivalent of the Greek Guardian, in which the bosses didn't pay the workers. What did the workers do? They waited for a couple of months, they weren't getting paid, so they took things into their own hands. They went back into the workplace. This is a mass meeting of workers at the newspaper deciding to produce a version of the paper under some kind of workers' cooperative production and flog the thing across Athens, where apparently it sold much better than it did when it was a boss's paper. Out of these kind of glimpses of struggle from below, we can begin to see a solution to a crisis. It'll be a long process of accumulating these forces, but I think one of the central things we have to do is raise demands not in order to talk about how we patch up and repair the capitalist system, but we raise demands in order to talk about how we protect, defend, and strengthen workers' capacity to struggle, their combativity, and confidence in the crisis. I'll finish there.
I just wanted to ask a couple of questions. The first one does relate to the graph that was shown showing the long-term decline in the profit rates. I think one of the things that's sort of surprising about that graph is that it appears that the period of the steepest decline in the profit rates is also coincides with the period of the long boom, the golden age of capitalism. And that's a bit surprising to me, in that it seems to be that the sharpest drop-off in profit rates is at a time when we know capitalism was in a long boom, there was full employment, high levels of investment and this sort of thing. So I wonder if somebody could explain that a little bit more. It's probably in Andrew's book, but I think it would be useful to sort of get a bit more understanding of that, because it is such a... that's the main thing that strikes me when I see that. This is the period that we spend a lot of time trying to explain, you know, that there was a long boom in capitalism, with the reasons for that, and this seems to be the very sharp drop-off. So that's the first question. The second question really is about finance, because most of the mainstream accounts of the crisis focus on finance, and I'm perfectly prepared to accept Joseph's presentation that really what is going on is a more underlying problem within the system itself. But I'm a little bit concerned that sometimes this just seems to be asserted in the presentations, that, you know, we know that it's going, we know that the real economy, or the productive sector, if you like, is in decline because of all these profit rates, and that explains why there's a lot of activity in finance. I think we probably need, it would be useful, I think, if we had more of an empirical sort of proof of how the crisis in the productive sector has actually fed into large amounts of activity in the financial sector, which then led to the crisis that we see today. It's just a comment really, but I think if you've got graphs or explanations along those lines, it would be very useful for us. Thank you.
Yeah, this is a question I asked Chris Harman several times before he died, and I never got a completely satisfactory answer. And I'm going to ask. So I'm going to ask Joseph. I mean, Joseph And it was a fantastically good talk, and he explained how modern capitalism has been unable to resolve its crisis because of the centralisation and concentration of capital. Capitals have got too big to be destroyed and devalued in a slump. And the question I asked Chris is, isn't that what happened with the collapse of Stalinism? So you had the Soviet Union, East Germany, Czechoslovakia, big industrialised economies, which actually disintegrated. A lot of it was bought up by Western capital, and were able to make a lot of profits out of it. And in a smaller way, isn't it, and this is something I thought of after Chris died, isn't that what happened to British capitalism? If you look at a car industry, I remember when I first joined IS, the car industry, I think British Leyland employed something like 500,000 workers. I mean, it was a huge industry. When I was a baby, I think it was the biggest exporter in the world. You look at the textile industry, you look at the steel industry. In Britain, they virtually disappeared, or where they haven't disappeared, you look at, say, the British car industry, parts of it are now profitable precisely because it was sold off and broken up, and the more profitable parts were taken over by foreign car companies and have now become profitable. So, I mean, I'd just like to know how he explains that in relation to his question, his explanation about the concentration and centralisation of capital.
Thanks, Ken. I work in manufacturing, though I'm in the office, and one thing I've noticed over the last few years is the concentration of different areas where parts of the industry I work in, which is the abrasive industry, have been kind of gobbling each other up, mainly with some of the companies in a bid to save the workers the jobs and the profit they already have by grabbing from another place and then stripping it. Another thing we've actually found within this industry as well is, as this has been happening, more and more the smaller companies get gobbled up. But the only problem is the small companies that are left have more trouble trying to trade, because we have trouble getting the raw materials, because we don't have enough money to buy in the quantities that we now have to buy in. And we actually spend most of our time scrabbling around the world trying to find it where we can get it cheaper. And the companies think, great, we can get a bit more out of this. Okay, your minimum is now £5,000. 2 days, a couple of months later, oh, this is now going up, you're now paying £7,000. Oh yeah, and by the way, you've also got carriage on it. And then you look at what we're making, and then we say to the customer, sorry, we've got to put this up, and the customer's going, we can't afford this because we're going to end up going out of business. So there's this whole cycle of when you start taking a profit and trying to make more profit, is squeezing more down the line, squeezing more down the line, squeezing more down the line, and then you get this absolute explosion, and then more and more people end up out of work, and we do lose our semi-skilled and our skilled people. And where do they go to? There's nothing. You look at whole swathes across the country where there is absolutely nothing. There's no work, there's no hope, there's no prospects, and all there is the job seekers allowance, if you can get it. You know, then you have to try and say that you're proving that you're looking for work. My son has been trying to look for work for nearly 3 years. He has to prove it. So he keeps going up to prove it. He walks up there and the first thing he says, oh, here comes a guy with a limp. He has had one job interview in the last 3 years. It's only one he's had. And they said, oh, he's too sweet for this to be his first job. And that was the only reply he had in everything he'd sent off in 3 years.
Simple, straightforward question. If credit fuels overproduction, can we actually say that values are out of line with market prices? And if we can, is it even theoretically possible to measure it?
Joseph, thank you. I've got a question about the graph you put up earlier, which showed the contrast between the traditional banking sector and the so-called shadow banking sector. If I recall correctly, there was a sharp decline in the shadow banking, which you traced to the collapse of Lehman Brothers and so forth, 2007. But as I recall, the traditional banking sector has apparently continued to grow at the same rate, and these graphs up to the end of 2010. So it'd be interesting to know whether this trend continues.
Yeah.
Thank you.
Yeah, I've got a general question. I apologise but I mean, I look at your graph of falling rates of profit, and this kind of worries me because we look at a lot of these graphs and information that come out about profit, and Marx talked about profit, but he didn't just talk about profit. And I wonder, it worries me that a lot of these graphs that we see, they're actually taking accounting profit or company returns or rate of returns, and these are all things that companies invent in order to often make themselves look as low taxed as possible. Whereas Marxists, we should be actually looking at an underlying rate of profit. Marx talks about surplus value, and surplus value is basically profit plus interest plus rent, and in the long post-war boom, which somebody asked about the idea of why was the rate of profit falling, the state took a percentage of the surplus value to pay the social wage. And of course that is something that's under attack also at the moment, so we have to know about this. So what really matters actually is not so much the falling rate of profit, but how is the actual surplus value going about? And this actually has a quite intimate connection to the ownership of companies, because the reality is most capitalists these days don't directly own the firms they control. The capitalist has moved on from straight ownership. A lot of shares actually belong to pension funds, to institutions like that, who only take profit. They don't actually take any control in running the organisation. The organisation is run by people like Bob Down and stuff like that. Now, in a previous meeting, somebody referred to these people as being very highly paid bank workers. Actually, they're not. They are capitalists, even though they don't own the firm. They are capitalists because they control the rate of expropriation of surplus value. And I think that's the key thing that we have to really think about when we're dealing with this. That, I mean, if you've thought this, I really apologise, but it does worry me when we look at these graphs and some of the actuals come out, that we're just taking their rate of profit or the system that they announce in their figures of doing that, and we're not really taking a proper Marxist analysis, which affects exactly how we look at it, because the system may be able to rescue itself by increasing the levels of rent it takes, i.e. through bigger bonuses, by producing these, by protecting themselves as capitalists, while at the same time actually pushing away some of the people that allow the actual rate of profit, the headline rate of profit, to fall because it's no longer of such importance or relevance to the capitalist class as a whole.
I agreed with Joseph's analysis of the tendency of the rate of profit to decline, the role of financial bubbles in maintaining growth, and therefore the form of the crisis we see. We're kind of caught between Scylla and Charybdis, between depression and financial crash, and the two are interacting with one another. I do have, though, a couple of points which I think do need to be considered. The analysis of the crisis of the Eurozone comes from Lapavitsas, and it focuses on wage competition. And I think the problem with this is that Lapavitsas tends towards a kind of a Keynesian position based on effective demand. And this, therefore, if you translate this into Marxism, it's a focus on absolute surplus value, rather than focusing on the technological competition of capital, and therefore relative surplus value. Because if you look at what happens when you adopt a single currency, without a single currency, technologically, and this is what Carchedi argues, technologically more sophisticated capitals claim a larger share of value throughout the whole economy whilst raising the organic composition of capital, but their currencies tend to appreciate. So what then becomes possible is that from the other side, technologically weaker capitals, although they devalue their currencies in order to sell more, but to maintain the same but smaller mass of profit. So that's like Germany versus Italy, if you like. Now within a single currency, all capitals their costs appreciate to the level of the Germans. But the German economy is technologically much more dynamic and has happened to exploit its workers more. So therefore, capitals are confronted directly, and the German capital now dominates the Eurozone, and therefore this has political implications, because you have neo-colonial phenomena across the whole continent. Essentially, if they are to move towards any kind of bailout, it will have to be essentially the ECB, the Commission become bailiffs for German capital, and Germany will then begin to take over sections of the banking system across the continent, and I'm going to have to leave. So therefore, I think it's also you don't emphasize enough the interconnection of the banking crisis and the state debt crisis, because the form of the financial crisis is really, really important, because bailing out the banks was no solution. Why? Because they gave the banks a load of free money, the banks bought state debt, but the economies continued to collapse. So the crises are interconnected. This is why the Greeks have to be smashed, and this is why it's very important. The Greek resistance is important, and that's why demands for nationalisation are central to us, because we expose politically what's going on. The attempt to make us pay for this crisis that's basically intractable, unless we're reduced to a form of debt slavery across the whole Eurozone.
Nick Brooks, I should explain to the comrade with the Black Panther t-shirt, it's quite, that these people like Kleiman and Michael Roberts are serious number crunchers, and they have been trying to look beyond the superficial appearances of capitalist accounts and actually work out the rate of profit in terms that Marx thought. But there are enormous problems with that. And in addition, when you look at the Kleiman diagram, there was an extra dimension that the first speaker picked up on, and that is that there's both a secular and a cyclical dimension to the movements in the rate of profit. The post-war boom had generally higher rates of profit than the more recent period. That's why it was the post-war boom. Then there was a crisis in the 1970s, shown quite clearly in the collapse in the rate of profit. But within the periods of the post-war boom, there are little dips which correspond with recessions. And likewise, in the period of generally lower rates of profit, if you look at those dips, they generally coincide with recessions. And for instance, the Kleiman figures show that the actual amount of profit fell in the end of 2006, almost a year before we were talking about a credit crunch, and the alarm bells were actually ringing. So I do really agree with Joseph when he says this is essentially a crisis of profitability. But I think it's also important to note that that is very much a minority point of view, even among academic Marxists. This morning we were talking about neoliberalism. Michel Husson thinks that what we have got is a crisis of neoliberalism. Kostas Lapavitsas thinks that we have a crisis of financialisation. The implications of those are extremely dodgy, because what they are suggesting is that let's sort out this little kink of neoliberalism, and then Bob's your uncle, we're back to business as usual under capitalism. And that is fundamentally false. That is not on offer. And so, okay. So I think I'll wind up there. I'll just say that I'm quite excited. I got a book out this week for the first time, so I'll be waving it around at you all at the end of the session.
Helge from Norway. Just about the question about tendencies of concentration of capital of firms. I think that's you're right, but I think we as Marxists have to understand it much better because it's not that simplistic. If you, for example, take the the first on your slides about oil companies, yes, they have become bigger and they became bigger in the late 1990s, but they are employing less people because they are sourcing out a lot of the activities. And underneath them, there's developed just the last 10 years. You have hundreds of new small oil companies coming up. So it's not a clear-cut way of the Marxists point that you have concentrating on capital, you have a crisis, and they buy up firms. It's too simplistic. We have to understand firms. And for example, the oil industry, the essence there is they become big because they not only concentrate on taking out profit, they are concentrating on taking economic rent. So they are some kind of super league of companies who are the average rate of profit, which is above other companies. And the reason is that they are so big, so they can leave oil fields when they are profitable. That's the way they do, and that's why it's developed a large chunk of smaller companies coming out of them. And if you go to other areas of the economy, you can see similar events. Take, for example, the company of Apple, the way it's developed. They also, it's about profit, but it's also about, in fact, economic rent. My point just is to say that we have to understand firms, and firms have history, and it's important to Marxists to understand different business models, etc., as we understand the history of the labor movements. And I think it's also important to understand the crisis, all these different ways that firms develop. I think we have to kind of detailed study on that.
Peter Jones from Australia. I just wanted to try and field some of the more technical questions that were asked throughout the session. So the question that was raised earlier about why the rate of profit starts to fall at the height of the post-war boom, but obviously the crisis doesn't happen until the mid-70s. Well, I think that follows a pattern that you'd more or less expect from a Marxist perspective. That at the height of the boom, you start to see the organic composition of capital rising, and it takes until the level of the rate of profit has fallen far enough that you get to a crisis. So it's a question of where the level goes in explaining that one. On the question about credit being meaning that prices could be out of line with values, and how could we then go about doing any kind of quantitative Marxist analysis. The way I'd conceptualise this is prices are not the same thing as value, but what's going on is an inflation of claims on surplus value. And you can distinguish a financial instrument that's a claim on a flow of surplus value from the prices at which goods sell. On the question of the broader measure of the surplus, of the rate of profit, and incorporating a measure of surplus value that's not just the profits that companies themselves report to the taxation agencies. Andrew Kleiman has done a study of that measure as well, that gives you a broader measure of the rate of profit that is based on GDP data and subtracting some things, if I understand that correctly. And that shows actually an extremely similar pattern to the measure based on just corporate profits as reported to the US state. And finally, quick question. I don't think, Joseph, your figures about unit labour costs necessarily demonstrate that German workers have been more intensively exploited, because unit labour costs are in terms of productivity. Anyway.
First, I wanted to repeat the chair's point that everyone should try and talk for at least 3 minutes, because if you don't give other people a chance to talk, then you're not a very good socialist. And second, I wanted to point out that in the talk we didn't talk about money creation. I don't know if people know, but there's a documentary out now called 97% Owned. That's 97% owned. You can find it on YouTube, and this talks about how nowadays in the UK, 97% of our money supply is created as interest-bearing debt by private banks. And this is a huge problem because they're allocating our money. We shouldn't be surprised this is happening, because our water supply, our food, everything is privatised. And until we democratise our money, we're going to be swimming in debt, and we're going to be unable to deal with these crises of climate and equality.
Yeah, I think one of the things that are so powerful about Marxist analysis is that you don't always start with what seems to be the case. So, the question from the comrade about why did it seem to be that on the one hand there was this boom, so it manifestly seemed the economy was healthy, but actually underlying that was there was a lot of unhealth in the system. And I wanted to just back up the idea that what has seemed like a period of relative expansion has actually been underpinned by stagnation. By just looking at the core of the system in America and thinking about the response of Alan Greenspan to the period from the 1990s onwards, because really, the period of neoliberal expansion or a financialisation of the economy was done really in a sense to stimulate bubbles in a kind of a manifest way. If you think about the economy, if you have an economy that's fundamentally healthy, you don't need, when you have the collapse of a massive bubble at the turn of the century, to try and stoke another bubble. But that's exactly what they had to do. So in a certain sense, since the 1970s, there have been a recurrent series of bubbles, asset bubbles, manifest crises which collapse, and then they try to stimulate another bubble. And that says to me that the only way the global economy can actually bring itself forward at the moment is through the manufacture of asset bubbles on the back of income distribution, which goes more towards the rich, and then they fuel these bubbles rather than a system that actually is underpinned with real growth. The questions I had, though, one question was, no one has really mentioned China, and obviously China has been one of the new phenomena of the last 30 years, an economy that was worth a couple of 100 billion, now 5.5 trillion, the second biggest economy in the world, hundreds of millions of new proletarian workers with surplus value being pumped out of them. So I want to bring that into the question. And the very last question, and it might be that Andrew answers this, in terms of there are Marxist economists like Fred Mosley and people like this who say that roughly they would agree that the profit rate falls to 1980, but then it recovers on the back of the political project which we would call neoliberalism, or I call neoliberalism Thatcher and Reagan. And all I want to ask is, and this may, and I'm not saying that's wrong, but just in terms of the manifest response, obviously what you can see is a political project which responds to a falling rate of profit. But then that political project obviously rolls on in terms of rolling back the state, attacking wages, but it doesn't seem that there's been a consistent crisis for them until the 2008 period. So how do we explain that we didn't get some level of recovery in profits? After all, if Joseph is right that profit rates drive the system, well then surely if the profit rate was continuing to be in stagnation, we would have seen a different political response than the current one.
This was an important talk, and I think the entire topic is crucial, both because all of our lives are caught up in this, and because there is a debate on the left that's sharp, and it needs to deepen, and Mick Brooks was addressing that at the end of his comments. We can call this, in the last session where Ann Alexandra spoke, we can call this a crisis of neoliberalism. There are forms of appearance of this crisis that are clearly different than those of the crisis of the mid-70s, early 80s. But we need to keep in mind that when people call this a crisis of capitalism, they mean it as, they call it a crisis of neoliberalism or financialization. They mean that in contrast to a crisis of capitalism, one rooted in the system of capitalist production. They want to blame the neoliberals. They want to blame, the financial interests. And when we've seen this again and again, what they really want to do is to create a broad, multi-class alliance, wherein all kinds of people and classes in society that are opposed to neoliberalism band together. And I think that this is selling out the working people, proletarians and peasants of the world. And I think that that's why this debate is sharpened and needs to sharpen. On the whole issue of the last 30 years, and especially the tie-in between bubbles and what's going on in production, in the U.S. case, you have to look at the Federal Reserve, and you have to look at the government role in the creation of bubbles, especially in the period after the collapse of the dot-com, or the period of the collapse of the dot-com bubble onward. I mean, basically, that whole real estate thing was a bubble created by the Fed.
You did have another minute, actually.
Oh, I have another minute? I
Just following on the other speaker, I think some of the sort of other explanations that are trying to explain the crisis are trying to explain a sort of contradiction in people's experience, which is that people can see that the austerity agenda is just hammering the working class and the poor, but it can seem like the 1% are actually doing quite well. If you look at the graph of an inequality between bosses and workers, if you there's all this, there's a scandal about Diamond, there's CEO bonuses. You hear about companies that 5 years into the crisis are making massive amounts of money. And so it can seem like there actually isn't a crisis in capitalism, that it's just really mean people. And if you read Naomi Klein's shock doctrine, as amazing as it is, it can give a bit of a conspiratorial point of view that Milton Friedman had this idea that they implemented in the 70s because he was really smart and really mean, and that now this idea has taken hold of capitalists, and it's sort of a sort of idealist explanation for what's happening. And of course it also leads to very reformist conclusions, because it says that the underlying system is fine, and if only we remove this neoliberal ideology, that we can get back to the way it used to be. In the 50s it was so wonderful. So I just wanted, maybe we can talk a little bit more about how to resolve the contradiction that people see, where it appears like the 1% are doing quite well, when in fact, as the graph shows, this is a crisis actually of capitalism itself.
I just think this chart that Joseph put up, I think Andrew's chart, the one about the declining profit, over the rate of profit over the last 50 years is crucially important, because the question somebody asked early on about the destruction of capital and actually what effect that is crucially important to understand. The reason there was 20% profit rates in 1947 was following the destruction of the Second World War, and the destruction between 30 and 40% of the world's capital. And actually, in the 1980s, the idea that somehow the destruction of British Leyland or something like that would be enough to restore profit is actually not true. Actually, we're talking about the destruction of 2 or 3 major economies. France and Germany would have to go to the wall to actually create enough then. Now, 20 years on, we are talking again that for capitalism to restore itself, it has to talk about the destruction of a major part of the world economy. Now, that is, and what is important about this debate is actually we are trying across the world in various places right now to fight for the re-establishment of revolutionary socialist ideals. It's really important that what we're putting forward is an argument that capitalism has got a period of crisis that is not about to just suddenly vanish by deregulation of banks, by the nationalisation of various things. Important arguments though they are, we are moving in a period where social organisation and the question of actually how you can actually end capitalism becomes a real debate. And that's why this debate of economics is important, because it's not just based on some kind of idea of what we would like, but of actually what is.
Yes, this is a crisis of capitalism, but it's a crisis for ordinary workers, for ordinary people. That's what the crisis. The capitalists haven't got a crisis. Bob Diamonds, who wrote The Capitalists, they're laughing all the way to the bank, from the bank. It's their system. It's got a structural flaw in it, as Joseph was saying. What my understanding is that how it works is there's the long-term tendency of capitalism of the profit rate to fall. So there's a long-term tendency as decades go by for it to the profit rate to go down, as Marx and Engels explained. But there are crises as in that period, which is caused by overproduction, and as they say. But what Marx and Engels says was, it's system stands like a ghost between the workers and what they need to do. Precisely right now in this slump, we've got building workers out of work, we've got houses that need to be built, and homeless people, and it's not being done. Why? Because the capitalists are hoarding the money. Why are they hoarding it? Because they can't use it to exploit human labour. The system has gone into this structural default, which it will get out of if we let it. It goes up and down and on and on and on until we can try to get together to form enough force behind our movement to stop them. We need to occupations, strikes, demonstrations and picket lines. That's how we fight it. Our side can win. You don't have to say this capitalist crisis. Yeah, it's really brilliant that we analyse it and get to the root of it. The economists explain what's happening, but it's not just an academic exercise. As Marx says, philosophers interpret the world. The point, however, is to change it. That's why we're doing this economic analysis. There's a few things I wanted to say, but I sort of swallowed the words I wanted to say. Yeah, but the other way I used to try and explain it to myself was as the first capitalist that produces one particular thing, a widget, gets in and makes a lot of profit. Other capitalists see that happening and they invest it. They invest money because they can see they can exploit labour to do it. They invest money to produce widgets which get sold on the market. But over time, and it's a continual process, not every day it changes, the price starts to drop and they start making less profits. And so the system starts to go into decline. Now this is the point I wanted to raise, because I said Engels' socialism, utopian and scientific. That there's a productive mechanism going on. The forces of production under capitalism are extremely powerful. After feudalism, production really increased. But the system of exchange didn't really change. That's why what I think is the... I've got to stop. Okay.
I just want to emphasize the last point of Joseph's speech, because I'm thinking it's a logic of capitalism that we occupy the factories, because if you consider you buy a consumer product, a cell phone, anything, and you can't pay for it, it'll be repossessed, or you'll be given a fine, or you'll be jailed. If the bosses don't pay our wages, the money that's yours for the time worked, well, it's only logic that we repossess the factories or machines that we've operated. This is logic. And start running the shop. Now, I want to ask two questions. Instead of bailing out the banks in the first place, like the Americans did and everywhere else, would it have helped, or would it have been better for the system to have bailed out the struggling homeowners? Because money would have tunneled to the banks eventually. And another question: how long can the United States operate without defaulting with their enormous debt?
I think I counted 27 different questions, so we'll get a minute for each. What I'm going to do is I'm going to pick on the questions I want to answer. If I don't answer your question, come and grab me either after the meeting or at some point, and I'll try to answer it. First of all, someone said that the profit rates we use are from accountants, and of course we are reliant on capitalist institutions to give us measures of profit rates. Unfortunately, there is no government that uses Marxist methods to give us measures of profit rates, so there's not very much you can do about that. But I think it is a problem that so many Marxists either do pure abstract theory or we do empirical work that's not informed by that theory. And we have to try and bridge the gap, and often that means using, if you like, bourgeois data and capitalist data to try and get a picture of what's going on. I make no apology for that. That's something that we're just forced to by the reality of working under capitalism. Is there accountancy fraud? Sure, there is accountancy fraud, but we have to try and navigate through that and do the best we can. Secondly, the fall in profitability is concentrated in the 1950s and 1960s. There is no contradiction between that and the fact that this was a time in which capitalism was booming. The whole point that Marx makes in The Third Volume of Capital is that the tendency of the rate of profit to fall flows precisely out of the attempts of capitalists to raise their productivity. It's when capitalism is generating the most profit that there is most scope for accumulation. And that process of accumulation, of ploughing the profits back into productive capital, itself undermines future profit making. That's why Marx talks about fundamental accumulations of capitalism, because accumulation is self-contradictory, and that's why the system runs into crisis. So it's not terribly surprising that the point at which profits are highest is also the point at which they fall off most rapidly. That doesn't take away from what people have said about the permanent arms economy. The reality is in the 50s and 60s, the fall-off in profits would have been far more rapid had not vast amounts of surplus been ploughed into completely wasteful enterprises like arms production, which don't then feed back into the wider capitalist system. There's no contradiction between the two. The permanent arms economy isn't a system that raises profitability, it's a system that means that profit rates fall more slowly. That's the way I would understand it. Okay, the third thing, people asked about the growth of finance. I agree we need a more detailed account of all kinds of things I spoke about. I was trying to do the ABC because I understand there are people in the room who don't necessarily want to engage in that level of complexity. But yeah, we do need a more complicated account of the rise of finance. And various people talked about what that account would involve. Lots of people have written about the needs of capitalism as capital escaped from, went beyond national boundaries during the long boom, the need for a financial system that supported flows of capital on a global scale, the need for a greater fluidity, the beginnings of a system of floating exchange rates and the possibilities this created for speculation. Andrew spoke quite rightly about government policy, because it's absolutely clear in 2001 when the dot-com bubble burst, what did Bernanke do? He immediately slashed interest rates and quite deliberately fostered another bubble in housing. So government policy is also a key part of this picture. There are also the prosaic incentives of this is where you can make a huge amount of money, so put your money in finance. There's a whole series of different elements of that explanation. What I think is missing from many of the accounts is an account of the underlying weakness of the capitalist system. We have to understand the rise of finance alongside the problems that underlying the crisis of profitability for the last 20 or 30 years, and that long period of the stagnation of capitalist production. You need to integrate that into the account as well as part of the explanation. Ken asked me a very difficult question about the collapse of the Soviet Union. I think in some ways it does epitomise the process I'm talking about, but carries it to its logical conclusion. When you're talking about the Soviet Union, what are you talking about? You're talking about a place where the concentration and centralisation of capital has reached the point where you can talk about a single capitalist firm on a national basis, operating on the terrain of global capitalism and trying to compete with other state capitalist formations on a global scale. That's what you're talking about when you talk about the Soviet Union. And that's why the form taken by crisis in the Soviet Union is the form of a long process of stagnation. And Chris Harman does write very, very well in his analysis of the dynamics of the Soviet Union about that long process of stagnation. It also meant that the option of allowing bits of the system to collapse, both for political and economic reasons, is more or less closed off. And it means that when the Soviet Union imploded, it really imploded. It imploded in its entirety. To answer Ken's question, did it boost profitability? It's certainly true that some of the old ruling class managed to grab firms and run them extremely in a very profitable way. And it's certainly true that Western multinationals and speculators went in, ravaged the economy and grabbed huge profits. I certainly wouldn't deny that. But it also shows the other side of the dilemma, doesn't it? Because the collapse of the Soviet Union was accompanied by an absolute impoverishment of the population of that country and the absolute collapse of large chunks of the system. Just look at the mortality rates, the absolute decline in production in large sections of it. It shows part of the problem faced by the ruling class, that when capital units get bigger, the possibility of a collapse that drags the entire economy down into a slump that it can't drag its way out of is a very, very real prospect. So it shows both sides of the dilemma. Okay, 3 other points. Someone asked about the analysis of the Eurozone and am I simply relying on Kostas Lapavitsas? Let me first say that I don't agree with Kostas Lapavitsas over financialisation, and I don't agree with him over profit rates. Nonetheless, I think there are useful elements in his account of the Eurozone crisis that we have to draw on. I agree with Andrej Zivkovic, who talked about the higher level of productivity in Germany. That's also part of the explanation. I would say that the crucial aspect of the explanation for the period of the Eurozone was probably the German ruling class more effectively keeping a lid on wages. I would still stand by that explanation as part of the thing. Where we have to go beyond what Kostas Lapavitsas and other people write is we have to contextualise this in a general picture of a long-term crisis of profitability, and until you resolve that and restore growth across the Eurozone, you can't resolve the problem of the sovereign debt crisis. We have to see it, we have to use the material they produce, but we have to put it in that wider context. Okay, 2 more points. The China question that people posed towards the end, there is another meeting on China, it's the next meeting in this course, you should come along to it. All I would say about that is that if you look at the way that the Chinese economy is developed, I think there are real problems in sustaining a boom based on the accumulation of 50% of GDP, holding down wages and exporting in vast quantities to more developed areas of the world. And I think one of the things we've seen in recent months is the Chinese economy beginning to run somewhat into the buffers. I honestly don't know, I don't think anyone knows whether China's going to have a hard landing or a soft landing. We don't know whether the ruling class in China can navigate that passage to a much more higher, high wage economy, more directed towards internal investment and so on. What I think we can say is that process is going to be very, very difficult for the ruling class. There will be explosions of struggle, there will be downturns, and it's not a simple onwards and upwards story in the case of China. The other thing we can say is that China cannot rise above the general crisis of capitalism. Look at what happened in 2008, a massive stimulus package, but it now seems increasingly clear that that stimulus package fed into unproductive investments that will never turn a profit, also into a property bubble, and also into vast amounts of financial speculation. There's a fascinating article about the meltdowns of bits of the so-called Chinese shadow banking system. For example, credit guarantee companies that have begun collapsing in China. There now seems to be a genuine, the beginnings of a bubble developing in China, which poses some of the problems that the wider world economy has faced. So I don't think China can simply remove itself from this general picture, and it will rely very much on what happens to its capacity to export, which depends on what happens in America, Europe, and elsewhere. It's part of a global system, and the fortunes of China will rest in that. Okay. Finally, because I don't have time to come back on any more questions, let me just talk a little bit about what our role in all this is. And the first thing is part of our role, surely, is to explain what the hell is going on, because no one else is offering a serious explanation of what the hell is going on at the moment. And as I apparently told a Guardian journalist last week, the revival of interest in Marxism, especially for young people, comes because it provides tools for analysing capitalism, and especially capitalist crises, such as the one we're in now, Choonara says, according to a Guardian journalist. I'm not sure I said that, but anyway, it's true. So,
if you did,
yes,
you should have done.
I certainly should have done. That's a huge part of what we do. We provide an explanation when no one in the ruling class and the mainstream can do so. The second part of what we do is critical, though. We don't provide an explanation simply as an abstract exercise in proving that we're cleverer than the mainstream economists. We do so in order to inform and deepen our struggles. That's something that informed Marx's analysis as well. There's a fantastic passage, it's in a letter he wrote, where he says, I'm writing this book about economics, what eventually became Capital. I'm going to score a political victory for our party, for the Marx Party. In other words, even the process of writing Das Kapital was about winning a political battle, a battle for ideas inside the working class to promote and develop our struggles. If what I'm saying is even 50% true, we're looking at a long period of crisis, of revolutionary explosions, and a period very different from the one that we've lived through. If that's true, we have to talk about organising, strengthening those struggles, and building revolutionary ideas within them. So if you haven't joined the party, please do so.